Hey, it's David here, the CEO and founder of the Freedom Founders Mastermind community. A lot of people ask me, hey, David, how are you able to discern or differentiate between different investments in real estate? Which ones do you think are good ones based on the current economy and the marketplace? Which ones are bad ones? How do you know? How do you filter? As you can imagine, with Freedom Founders, we have a lot of member capital that we're able to use as a leverage point, meaning a lot of real estate investors, business owners need capital to make their market in whatever niche in real estate, whether it's single family houses or multifamily or self-storage or mobile home parks, retail centers, whatever it might be, they need capital and we provide that capital. That means we have a lot of potential suitors, those who want capital. I get so many requests that we've created over time filters, so I can filter out the signal, the good stuff, from the noise. And there's, as you can imagine, way more noise than there is signal, good opportunities. One of the ways to do it is just to have the opportunity over many, many years, 40 plus years of my own investing and learning to be discerning and due diligence, asking the right questions, underwriting, so much that has just become a part of my DNA, part of my vernacular. Just like anything you might do in life, when you do it over and over and over again, you just become accustomed to knowing what questions to ask. New investors, people who have invested in real estate, this is a new game for them. And there's always a place to start learning, but this would be a bad market right now to be learning on your own. What I'm saying is we've topped out. Now, does that mean there's no good investments? Of course not. There's always good investments, but the fact is that most people don't have a comparative advantage. In other words, I get to look at a myriad of investment opportunities over a month's period of time. I mean, in the hundreds. Now, again, we have filters, so I don't have to look at all several hundred of them, but curating those down to the top few means there might be 4 or 5 out of several hundred that I might feel are appropriate for the Freedom Founders group. And even then, we do a deeper underwriting, due diligence. We spend a lot of money, invest a lot of money to make sure and ascertain for our members and for myself included, does this particular investment meet the mark? We do background checks on the principals of the operators, the managers of the investment opportunity. We have a securities attorney underwrite the entire offering to make sure it meets market clearance in terms of the documents themselves and of the economics of the deal. Does it make sense at all? Let me give you a quick example. I'm on many, many lists, as you can imagine, and I caught one the other day, just caught my eye, and I'm going to read it to you so you can get a sense for what came across my desk. Greetings from XYZ at XYZ Capital Investors. New deal alert. Build to rent in one of the nation's best MSAs, metropolitan areas. Phoenix. One-time investment, lifetime cash flow. Register for the investor webinar on blah, 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 blah. Okay. I'm sure if you're out there in the real estate space at all, you get something similar all the time. How do you know? I mean, it sounds good. I'm sure. Well, I'm pretty sure. In fact, I happen to know who this group is. So I know, like most groups who are investing in different kinds of real estate syndications or funds, most groups, if they have integrity, they've probably done decently, if not pretty darn well, in the last 4 or 5 or 6 years. Why we've had an up market. The problem is what happens when we have a correction. We have headwinds like we have right now. Inflation, interest rates going up, changing the cost of capital, the dynamics of the housing bubble. Well, the nice thing about real estate is it's very localized. You can't just have a national housing market. It doesn't work that way. It's not like the national stock market. When the national stock market takes a big dip, it's like everything goes down. If you're investing in index funds or mutual funds, you pretty much just ride the volatility of the market. In real estate, we can carve it up by demographics, geographics, asset class, by the capital stack, equity versus debt. A lot of terms that you may not be familiar with, but trust me, we can slice and dice it. Why? Again, because we have so much of a comparative advantage. We get to look at a lot of deals, and we have the strength of our group to leverage the best deals and to have the power, the community power to underwrite and do the due diligence, which as an individual, you couldn't do. You wouldn't have the capacity, the cost factor wouldn't work for you, and you just don't know the right people. It's just a fact. So in this deal, what am I looking at? Well, Phoenix. Okay, let's talk about Phoenix number one. Phoenix, I just looked up some stats, and this comes from Realtor.com, comes from Zillow, comes from Redfin, Bureau of Labor Statistics. All this data is available. Again, you can put your hands on it, but do you know how to curate it? Do you know how to put it together? Do you know how to read the tea leaves? That's what it comes down to here. So Phoenix, what's wrong with Phoenix? I've got a sister that lives in Phoenix. I think Phoenix is has a lot of attributes to it. A little too hot for me, but there's people that like to live there for various reasons. Phoenix is typically a volatile market, like California, like some parts of Florida, like Las Vegas. When the market goes up, Phoenix typically goes up a lot. It's close to California. That's one of the opportunities. There's a lot of money from California that moves into Phoenix to get away from the high tax state and a lot of the other things about California that people don't like. So they move to Arizona, to Phoenix many times. The Phoenix market is one of the top markets that has gone up appreciably in particularly the last couple of years. Is that bad? Not unless you're buying at the top of the market and thinking you're making a great investment. It's probably not a good idea. If you bought earlier, like 2 years ago or earlier, then you probably have the benefit of riding that market up. And then, do you know when to take your chips off the table? And then where do you put your money? That's a discussion for another day. There's been, in the last month and a half, there's been a 123% increase in the housing inventory in Phoenix. 123, that's more than double. Well, if there's more inventory on the market, more supply, what's that do to the supply-demand ratio? Well, that means it's going to decrease some of the demand. It's going to cause a decrease in the listings. In fact, over 40% of current real estate listings in Phoenix are showing price reductions. Over 40%. What's that tell you? The market's cooling off. It's starting to come down. The price to earnings ratio, that is the price of housing versus the annual average wages of those in Phoenix, are an 8x, 8 multiple. The average, the stability marker for Phoenix is 5x. So that's what, a third more? It's a third higher on the kind of the affordability aspect. In the top listing of MSAs in the country that are in the higher propensity for crash, Phoenix is up there. And it's going to look like it's going to have to take an overall reduction of probably somewhere between 26 and 33% in bringing that price point back down again to what that market can afford. Building permits are way up. The price to rent ratio is way up, meaning the price of housing relative to the cost of rent. Rents have gone way up. There's so many factors in Phoenix, and there's other MSAs that are in a similar category. I'm just picking Phoenix because this is the one that came across my desk. So build to rent. Build to rent has been the sexy model for the last 4 or 5 years. And again, until price points started getting out of hand in the last 2 years, way out of hand, I think build to rent has been a great model. I mean, you get a brand new house and built at the right price to rent ratio. Yeah, there's a lot of benefits there. But with the high cost of these new construction houses, where supply chain issues, wage, labor costs, material costs have been going up, and the cost of capital has pretty much close to doubled in the last 2 months. All those factors are meaning the cost of new build construction has gone up and is going way up. Rents can't keep up pace with it forever. It goes back to the affordability factor. The baseline adjudication for is our prices too high is what's the average wage base in a metropolitan area. So the big problem is in some of these MSAs, Phoenix, Dallas, Austin, parts of Florida, I can name a whole host of them. There's been a lot of private equity hedge fund money that's come in to find good yields in the real estate markets. Well, as yields go up in other less risky investments like bonds, well, interest rates go up, bond yields go up. A lot of that hot money from private equities on the move. In other words, it's going to leave the real estate market. And when that money leaves the real estate market, who's the marginal buyer? I mean, who's buying on the margin? Well, if you take that away, then that market's going to drop. So back to my point. While build to rent has been a strong model, and I'm sure those who have been doing it well, we have people within Freedom Founders that do it well, but right now, you got to know the market. What market are they building in? Is that market going to sustain its price point and its rents? Phoenix? No way, Jose. It's not going to happen. So my message out to a lot of my folks about this particular investment, it's not part of our group. In fact, I happen to know something about the principals. We did a background check on them when they wanted to enter our group about a year and a half ago. They got some issues. I'll say that. We wouldn't let them in. But that's not because of the build to rent model. It's just because they have issues. The build to rent model itself, I think, has real problems. So I told my members, deals like this, investments like this, these folks and investors who invest with them, late to the game. In fact, way late to the game. Realize that real estate syndicators and fund managers make plenty of money on the front end. They're taking acquisition cuts and management fees right off the front end. So whether these deals go through or not and really make the returns they're promoting doesn't matter to them. They got to keep the money churning to keep their lights on, to keep money in their pockets. It's what they do. And I'm not saying this is fraudulent at all. It's up to you, the investor, to dig down and understand how to underwrite these. If you don't know how to do that, then what are you investing in? And I see so much of that going on today where people are throwing money at the wind just because some syndicator or fund manager has had a good run in the last 4 or 5 or 6 years. Good for them and good for you if you're running with that, but how sustainable is that? That is the biggest problem I see in the marketplace today. And if you don't have the ability or the access points or the understanding or the knowledge or experience to underwrite yourself or have a team around you to underwrite these, you're gambling. You're gambling as much in real estate as you would be in the stock market right now. I think they'd be both gambles. In Freedom Founders, we have a confidence factor built in because we curate, we have comparative abilities to look at a wide array of investments, and we do the due diligence behind it. That's what keeps our members safe. If you're not doing anything like this, then you should not be playing ball in the markets right now. It's your freedom. You got to stay focused on it. Don't get complacent. Don't buy into the exuberant market if you're not sure what you're doing. That's my caution for you. I'll see you next time.